Hi, Matt McAleer, President and Director of Private Wealth, Cumberland Advisors, with the Moose. John Mousseau, CEO, Director of Fixed Income. Wow, month end, quarter end. You know, as far as fixed income, you're ducking arrows.
Yeah. Thank God the month is over, because it'd be hard pressed to find a worse month, certainly this year, than September.
Yields have been tough, and what has that done to the equity and even the commodities market? Equity-wise, the quarter, take a look at the quarter that started out strong. So it ended up flattish to down a tick. September, the major indices down 3, 4, 5%. What are some things that I'm noticing before we jump over to you, John? Sector-wise, some things are getting my attention. I mentioned last week, I keep reading research and people are saying, it's interesting that the defensives, the utilities, the consumer staples aren't getting much of a bid here. I still remain thinking that that's because the 90-day Treasury bill replaces that as a defensive parking spot.
Exactly.
Again, this week, utilities down hard, staples really couldn't rally. So those are some things in the back of my mind I'm watching, and why we're not going into those areas as a way to play defense right now. We'd rather stay with some cash at 5% looking for a reasonable entry. Another thing I noticed, because we love to look at spreads between industries, spreads between sectors, cross macro work. In other words, what is precious metals doing versus short-term rates versus equities versus international, all different ratios we love to look at. This month, almost a 20% change over the quarter between energy and utilities.
Huge.
22%.
Huge.
That dispersion is an area that historically, that's an extreme, historically has not widened much past that 20% range without a little bit of a snapback rally. So we've done well with energy. Do we keep energy and just maybe take a little bet on utilities? Or do we pare back on energy and focus in on some of that reversion to the mean trade? We'll look at that in the coming days, in the coming weeks. Just trying to share some things we're looking at day to day. The key is all asset classes right now are being held hostage to rates. What rates do will dictate the action in most of the asset classes.
Totally. You look at bonds, very rough quarter, very rough month. We have a couple of charts. The first chart we're showing shows the Treasury yield curve at the beginning of the quarter and now here at the end of the quarter. And you can see the front end of the yield curve hasn't changed very much. And it makes sense, right? We know the Fed didn't have a meeting in August, passed in September. So rates on Fed funds are still 5.25 to 5.5. What changed in the quarter? Very little from economic statistics. Most statistics show the economy slowing down. What happened was the Fed came out and said, and not just Chairman Powell, but other Fed governors, we are going to keep interest rates higher, or I should say high, for longer. And this chart backs this up. Because short rates have stayed high, they haven't changed very much. Intermediate and longer term rates have moved up because they're focusing on the longer.
Right.
And if it's on the longer, they say, well, we're going to have to get paid more if we're longer, and this drop down is not going to occur as fast as we want. And that's what drove it. It drove muni yields higher in this not only quarter, but certainly this month even more. Just the 10-year bond, Treasury bond alone was up 75 basis points during the quarter. The muni dealers, just cut and run. So for a 20-year bond, they might have cheapened it like 25, 35 basis points just to get a deal done. And of course, it reprices the rest of the market. So it was a very, very bloody month. Certainly, there's a lot of value in the market when you start looking at what the spread is over inflation with bonds. You're getting paid a very high real yield. One curveball in there, it looks like we are going to go into a government shutdown, here at least on Friday afternoon. We have a second chart, And it's just to show that the last 3 government shutdowns, 2 under President Trump, 1 under President Obama, both produced mixed results, up or down 10 basis points or so. Can't really read anything into that. So we're not predicting anything out of that. It's just kind of a return to, we think, is going to be some reversion of the mean here in bond yields as we go forward.
Yeah, what's always nice about bonds, and I have conversations with clients and investors and traders all through the day, all through the week, you still have to revert back, John, to the fact when you're earning on the long end or the short end. Let's take a look at the long end where some of the price damage is done. When you're earning a 4, a 4.5, a 5% coupon, you're still able to multiply that over 5 years. So if I'm earning 5%, I know over the next 5 years, simple interest, not even compounded.
Right.
I'm earning 25% return on that bond in coupon.
In 5 years.
Now our bet is that between now and 5 years, some of these rates follow a little bit of a softer inflation picture, and we get price appreciation. But the coupon allows you to be patient. If you were only being paid 1.5% on that, and you were getting price degradation, that's a problem.
Right, and that's the problem that occurred in 2022, certainly from the beginning of the year to almost the end. This year with rates higher, you're right. There's a feed bag of coupon that's going to take you a little bit, into the next year.
Right. So we always say it, but next week will be interesting. We always look at what can go right, what can go wrong, what's working, what isn't working. One thing heading into the close, and we're right before the close on Friday, the equity market, the S&P, kind of fighting rates, fighting a lot of things, fighting the shutdown, fighting strikes. It does look like we're going to finish above that Wednesday low.
Right.
So let's see how this level and the Wednesday level act next week. That's all we can do. They're not lines in the sand. Let's see if buyers show up at those levels.
Right.
And we'll go from there.
Exactly.
All right, Moose. Thank you for watching. We'll see you next Friday. Enjoy the weekend.